Forex is a simple term for a very large idea, the foreign exchange market. It is the global marketplace where the currencies of different countries are bought and sold. Think of it as a massive, decentralized network where money itself is the product being traded. When you travel to another country and exchange your home currency for the local one, you are participating in the Forex market on a small scale. Traders, however, do this on a much larger scale, not for travel, but with the specific goal of making a profit. They aim to capitalize on the constant fluctuations in the values of these currencies, trying to buy a currency when its value is low and sell it when its value is high, just like trading any other asset. The participants in this vast market are incredibly diverse. Central banks, like the US Federal Reserve, trade currencies to manage their country's money supply and interest rates. Massive commercial banks trade to facilitate international business for their corporate clients and also for their own proprietary trading desks. Hedge funds and investment managers trade to generate returns for their clients. Individual retail traders access the market through brokers from home on PCs or mobile devices. This constant activity makes Forex the largest and most liquid financial market in the world. This guide will take you through the core concepts of Forex trading in a clear, step-by-step manner. What you are trading, how those trades are executed, what makes the prices of currencies move up or down. The primary reason people are drawn to Forex is the potential for profit from these price changes, but it is equally important to understand the risks involved. The market is open 24 hours a day, 5 days a week. At the very heart of Forex trading lies the concept of currency pairs. You never trade a single currency in isolation, you are always exchanging one currency for another. This is why currencies are quoted in pairs. EUR USD, the euro versus the US dollar, USD JPY, the US dollar versus the Japanese yen. The first currency listed is called the base currency. The second is the quote currency. Example, EURR USD at 1.1050. That means 1 euro, SHA 1.1050 US dollars. When you place a trade, you are speculating on the direction this exchange rate will move. You have two basic choices: buy, sell. If you think the base currency will strengthen versus the quote, you buy the pair. This is called going long. If you think the base will weaken versus the quote, you sell the pair. This is called going short. Buy EUR USD and it rises, you close for a profit. If it falls, you take a loss. Prices are in constant motion, influenced by many economic and geopolitical factors, major news releases, employment reports, inflation data. These can cause rapid price swings. Interest rate changes by central banks are a powerful driver. Higher rates often attract foreign investment and can strengthen a currency. Political stability, trade balances, natural disasters, all can change how a currency is valued. Traders use economic calendars. Traders use technical analysis charts to spot patterns and trends. To participate, you need essential tools, chief among them, a Forex broker. A broker gives you market access through a trading platform. The platform is your command center. View live price charts. Analyze potential trades. Execute buy and sell orders. Choose a broker that is well regulated. Choose one with a good reputation. One of the most alluring and simultaneously dangerous features of Forex trading is leverage. In simple terms, leverage allows you to control a large position in the market with a relatively small amount of your own capital. Your broker essentially lends you the money to open a larger trade. For example, with a leverage ratio of 100.1, you could control a $100,000 currency position with just $1,000 of your own money. This can magnify your potential profits significantly. A small favorable move can result in a substantial return on your initial investment. But leverage is a double-edged sword. It can amplify your profits, and it can also amplify your losses. Using the same 100.1 example, a small move against your position could quickly wipe out your $1,000 investment. This is the biggest risk for new traders. Mismanaging leverage is the fastest way to deplete an account. Start with very low or no leverage and practice until you're consistently profitable on a demo account. Effective risk management is everything. The most fundamental tool is the stop-loss order. A stop-loss tells your broker to automatically close your trade at a set level, limiting the potential loss on that trade. Know your stop-loss before entering a position. A common rule of thumb for beginners is to never risk more than 1%, 2% of your trading capital on any single trade. Now that you understand the basic concepts, the most important next step is not to rush into trading with real money. The wisest and safest way to begin your Forex journey is by opening a demo account with a reputable broker. A demo account is a trading simulator that uses virtual, or fake, money, but operates on the live market data. It lets you experience the real trading environment, the platform, the charts, the price movements, without risking a single dollar of your own capital. Practice executing trades, test different strategies, get comfortable with the platform mechanics. Focus on building a solid foundation of knowledge. Don't just click buy and sell randomly. Start with one simple trading strategy or two. Find free educational resources, beginner-friendly articles, video tutorials, webinars from brokers and educators. Learn basic chart patterns and a couple of simple technical indicators. The goal isn't to be an expert overnight. Devolwait sambari birdie, sa bodila perdanan, beksamar dodikan ban. Consistent process for analyzing the market and making trading decisions. Treat your demo account as if it were real money to build good habits. After a few months of practice and consistent simulated profitability, you might consider moving to a live account. When you do, start small, look for micro accounts or cent accounts, risk just a few dollars per trade to feel real emotions without catastrophic loss. The emotional pressures of fear and greed are very different with real money, so starting small helps you adapt. In conclusion, Forex is accessible but challenging, speculating on currency price movements. It involves trading in pairs, understanding what moves the market, and using your broker's platform to execute trades. Leverage can amplify returns but also amplify losses. Strict risk management is non-negotiable. Your next step, open a demo account and commit to dedicated learning and practice. Approach the market with patience, discipline, and a focus on education. Take measured, step-by-step actions to build a strong foundation. That's where to begin.